Okay, well, I guess we're doing this. Here's yet another 3 fund portfolio recommendation on YouTube. Except, unlike the other ones, this portfolio is actually extremely well constructed. Let's dive right into it. But first, a quick disclaimer. I am not a financial advisor. This is not financial advice. Hey, I'm just a guy on the internet at the end of the day. It just so happens my investment strategy beat the global stock market over the past decade with less risk and is currently outperforming the S&P 500 for the moment. But, things can change. The content in this video is for entertainment and educational purposes only, and past performance, including for my strategy, is not indicative of future results. Investing involves risk, so always do your own research. First up on the YouTube 3-fund portfolios that suck is something I like to call Crouching Tiger, Hidden Spy. You'll see this a lot from various creators. They will combine a US large cap value fund with a US large cap growth fund, and then a so-called foundational ETF that's basically a clone of the S&P 500. Either total U.S. stock market or the S&P 500 directly. And I've got 3 things against this portfolio. First, it is actually essentially just the S&P 500. If you want to invest directly in the S&P 500 for a 1-fund portfolio, that's totally defensible. That's something that Warren Buffett has suggested. It's something that Jack Bogle has suggested. That's fine, but overcomplicating it to 3 funds that are just identically the S&P 500 when combined together, there's no sense in that. The second thing I have against this portfolio is it's entirely concentrated in US large cap stocks. It is the most extreme bet on domestic stocks possible. The third point that I have against it, there's no bonds. There's no diversifier of any kind. So in a tremendous stock market crash or a stagflationary period like the 1970s, this portfolio is going to suck for people. Look, I get it. Speaking out against the YouTube 3-fund special portfolio or whatever in all of its incarnations is pretty bold. But I've got the empirical facts to back up my position here. So you can see I've got the YouTube 3-fund special set over on the left side. These are the actual historical returns that you would have gotten from the Vanguard Growth Index, the Vanguard Value Index, and the S&P 500 SPY or SPY ETF compared to the S&P 500 itself and the total US market. We backtest it 99 years. Look, the CAGR and the money-weighted rate of return, almost identical across all 3 of these investment strategies, except you'll note that the YouTube 3-fund special comes in last place. Why? Because of the extra funds and grind and factors and hidden variables and whatnot associated with splitting the S&P 500 into that value, growth, and a clone of itself component. So you can see down here that if you went with the YouTube 3-fund special, you are actually going to underperform the S&P 500 and the total US market really long term. It's not that much of an that much of an underperformance. It's more like a tracking error. But still, why would you go for the YouTube 3-fund special when you could just invest in the S&P 500? So much easier, so much more simple. Now, I've also seen absolute abominations on YouTube. Like, instead of going for SPY or VOO, somebody does a concentrated bet on MicroStrategy or NVIDIA and puts that in this 3-fund portfolio with a value and a growth ETF. I'm not even going to dignify those approaches with a response. That's just way too risky. We don't need to cover it. I want to skip directly to the three fund portfolio I have seen on YouTube and its variants, which I think is pretty okay. I'm, of course, referring to Jack Bogle's actual three fund portfolio in its historical form. That is, investing 60% in the US stock market, 20% in the world stock market, and 20% in aggregate bonds, either aggregate domestic or aggregate world. The world is probably going to give a few basis points higher. In the end, probably isn't going to make that much of a difference, but that's the general format of the three fund portfolio. And Jack Bogle strongly recommended never going over 20% international, and he had his reasons, which I disagree with, but it is a defensible position. So let's look at how it panned out against the 60-40, the total US market, and the total world market, going back about 40 years, because that's how long we've had the aggregate bond index. You can see that the three fund portfolio comes in above the 60-40, but with a lower Sharpe ratio than the 60-40. So you're going to get more terminal wealth with the three fund approach. What's interesting is the three fund portfolio did outperform the total world market over this period, but that's largely because, well, it's got 60% in the USA, and the USA strongly outperformed over this period. If you look at the total US market, which would be equivalent to investing in VTI or any S&P 500 ETF, there's not much difference between a total US stock market fund and an S&P 500 fund just because of the size of the companies involved. You would have gotten a lot higher terminal wealth than the three fund portfolio with the same Sharpe ratio and a lot higher volatility, but that's primarily because you got lucky and the USA did very well during this period. I have not really anything bad to say about the three fund portfolio recommended by Jack Bogle. It's just a different investment philosophy than my own, which I'm going to share next because I believe that looking at factor investing and looking beyond bonds to a more diverse and broad set of diversifiers is going to get better absolute and risk adjusted returns in the long run. And so I'm about to show you the Miller Momentum 3-fund portfolio, or Miller Momentum Simplified. So my approach is I put 30% in the Invesco S&P 500 Momentum Index, put 30% into Avantis International Small Cap Value, and then 40% into managed futures, and the best index-like fund there is DBMF, which is going to follow the average or aggregate returns before fees and whatnot of the largest commodity trade advisor people out there. And I think that managed futures are a much better diversifier than bonds, and the data supports my position on this. So let's look at the back tests of the Miller Momentum Simplified Portfolio. So why did I choose the structure that I did for the Miller Momentum Simplified Portfolio? Well, if it ain't broke, don't fix it, and I don't think that the 60-40 portfolio structure is necessarily broken. 60% in stocks, 40% in alternatives. Okay, sounds great to me. That's what the Miller Momentum flagship does. It just diversifies those alternatives across active long volatility, catastrophe bonds, managed futures, and precious metals. What Miller Momentum Simplified does is it just uses one diversifier, managed futures, which is going to track trends across all diversifiers. It's kind of the grab bag of momentum or trend investing in general. And for stocks, because I don't have any strong position about whether domestic or international equity is going to outperform, I typically separate my portfolios into 50% domestic and 50% international. And so, as you can see, Miller Momentum's putting 30% in SPMO and 30% in AVDV. Why am I pairing domestic large cap momentum with international small cap value? Well, because of trend and trend reversal. During trends, the SPMO allocation is going to absolutely crush things. During trend reversals, it's going to stall and take a while to catch up to the new winners. In the meantime, international small cap shows strong tendency to outperform during trend reversals when everybody is looking at undervalued and overlooked companies with strong fundamentals. And the value factor is historically much stronger in small cap. And the reason I'm choosing international here is because if things are going wonky with domestic stocks, historically speaking, international value pick up the slack. And you'll see that in the back-tested data here. The options I've used in testful.io here to backfill is before the index for DBMF is available, I backfill it with KMLM to get about 6 years more back-tested data on a historically respected managed futures index. Thanks to our generous people working behind the scenes at testful.io. Again, I don't own the site, I just am a very big fan of it. We now have the index for SPMO going back about 30 years. And lastly, I've used DFA's DISVX fund as the predecessor fund for Avantis International Small Cap Value. Both funds use approximately the exact same methodology, so they're pretty equivalent except for fees and a minor profitability filter that Avantis factors in, but their returns are basically identical. So we're going to backtest the Miller Momentum Simplified strategy against the Miller Momentum Flagship strategy first. And as you can see, they're fairly comparable. I've boiled down all of the different philosophies involved in the Miller Momentum Flagship to their bare bones, most essential form to do Miller Momentum Simplified. They're basically on track and highly correlated with each other. You can see the correlation here is about 0.9. So pretty cool. Next though, I want to take Miller Momentum Simplified far into the past, which is something that can't be done with Miller Momentum Flagship because it uses some newer funds. So I'll skip right to the point. Over the past 30 years, the Miller Momentum Simplified approach has beaten the total US market, the total world market, and even Warren Buffett. Yep, that's right, Warren Buffett. And it's done so with about half the volatility, a much higher Sharpe ratio, an average drawdown of about half of the other approaches, a maximum drawdown of only about 28%, with a beta of 0.46. So there you go. Is it a good approach? Well, you tell me. I think it is. Here's the logarithmic scale to make the comparison a little bit more easy to trace with the eye. So you've got the Miller Momentum Simplified right there as the blue line, and it's typically on top. Warren Buffett has snuck above it a few times, but he's currently back down below the Miller Momentum Simplified approach. And because it is a simplified and modified version of the Miller Momentum Flagship approach, the Miller Momentum Flagship approach should, hypothetically, and has over the past 7 years, beaten the Miller Momentum Simplified approach just a little bit. But I understand that some people like simplicity, and 3-fund portfolios are popular for a reason. So there you go. There is Miller Momentum Simplified the official 3-fund portfolio of my channel, because it seems like everybody on YouTube has to have a 3-fund portfolio these days, so this is mine, if you care to check it out and research and look into it more yourself. I do want to say that the Monte Carlo simulations on this thing are pretty insane too, so let's just go over there and, for example, compare it to the 60-40, or yeah, let's just do the 60-40 just to give you an idea. So backtesting for 30 years with 5,000 simulations, starting value of $10,000, and usually takes about 10 seconds to run this. Here we go. The 60-40, your worst case, you're getting almost no return. Your median case, you're getting about 8%. After you factor inflation in, your worst case, you're actually losing money. Miller Momentum Simplified with inflation factored in. Worst case is you don't lose money, you gain just a little bit, but the median percentage here is 7% after inflation, compared to the 60-40's 5.3% after inflation. So it's punching right up there with the S&P 500, which is pretty cool. Thank you so much for watching Miller Momentum. Be sure to like and subscribe and keep an eye on the channel, because I am dropping a new video coming up very soon about something that I call the Immortal Portfolio, which beats even the Miller Simplified Portfolio, yay, even the Miller Momentum Flagship Portfolio. So, you might want to check this one out. Coming soon.